20. Sorry. Uh, for the next SoCal group's first event, we're doing our buyers workshop today, and we have some special guests with us. We have Justin with Edward Jones. He's our financial planner. We have Manny, who is our credit repair specialist, and Janelle, who's our lender. And we're going to talk to you about buying a home. Our first guest is Justin. He is a financial planner with Edward Jones, and also one of my colleagues, fellow alum. So welcome, Justin.
Thank you. Certainly appreciate the introduction. Once again, my name is Justin Briscoe, financial advisor with Edward Jones. Been in the industry for roughly 8 years. 3 of those years have been with Jones. Prior to that, I was with a wealth management company called American Funds, where I supported financial advisors in the position that I'm in now. So, pleasure to be here. I want to thank Heather Williams as well as Nikki Gant for the opportunity to speak with this home buying workshop. So I do have a presentation in place. However, I know there's going to be a lot of information regarding home buying and various strategies to get you underway, closing costs, as well as your home down payment. I thought I would start with a foundational standpoint of where your money is. And with that, get a clearer idea in terms of how you can approach the home buying process. So there's a whiteboard available, so I'm going to provide you with a illustration on the 3 ways your money is categorized that can certainly assist you with identifying where you can actually use money for your closing costs as well as your home buying down payment. Some of the documents you may see is a monthly budget worksheet for your expense plan, so you can itemize your actual expenses and get a clear idea in terms of what type of cash flow you have available as you continue to save towards that first home. This is actually an illustration that you can do with solving. So feel free to get out a piece of paper and follow along, or just look at the actual illustration. So what I'm doing here is essentially drawing a home. Roughly, that would be your annual expenses that can account for your necessary as well as discretionary expenses. Necessary being at this point maybe rent, utilities, cell phone bills. Discretionary would essentially be travel, entertainment. Just for a number, let's say maybe you're missing $100. Alongside this, you may have your net expenses. I'll just put N for abbreviation, whatever that number is. Okay? You also may have your monthly expenses. I'll put ME as monthly expenses for abbreviation. And I'll put CF for cash flow. Okay? After you pay your net expenses, you have a cash flow, your reserve, depending on what you may decide to do with those assets. The first of the 3 categories is your taxable bucket. Under this taxable bucket, you have your checking account, you have your savings account. Your savings account can be multiple savings accounts. It can be, in this case, the home buying fund. It can also be emergency savings. Those 2. And you also have your investment fund, which can be other cash alternatives. Okay. Now, when we look at various ways of saving towards the home or the closing costs, traditionally, in a checking and savings account, you may have your standard FDIC bank, Chase, Wells Fargo, Bank of America, your standard credit union. It's roughly going to provide you with maybe 1/10%, right, which is really 1.2% annually, not that much money in terms of money. That's what's most common. A step above that would actually be an online savings account, where online savings accounts with interest rates being up over the past 12 to 18 months You have a sizable amount of interest that you can get outside of your FDIC bank. With that, you're looking at roughly maybe 3%. A step above that is actually money market that can also be used for your money liquid, and you can utilize that as a strategy to save as well. Those particular accounts roughly range around 4%, depending on the actual institution that you utilize. So this is certainly a great way to have money working for you, as well as it being liquid. A step above that would be these investments here, and another cash alternative, which is called a CD, a certificate of deposit. If you have a longer period of time before you actually are looking to purchase a home, say maybe 6 months to a year, right? And you're comfortable with your money being locked period, you very well can put your money in a CD, where it matures at a certain point, and you have an actual interest amount that you can count. Okay. This illustration purchases up to 6 months, 3 months, 6 months, 9 months. The second category is tax deferred. Tax deferred is most common when you have an employer, whether it's a 401k, if you're an educator or work for a nonprofit, you may have a 403b. If you're a government employee, you may have a 457. Okay? In addition to that, you may have a traditional IRA. Within these buckets here, you have what's called a loan option. Depending on how your employer plan is structured, you may have a loan which allows you to pull money from that in your retirement savings, and also utilize that as money for down payment for the house. Typically, you can pull up to 50% or up to 50,000 or whichever is less, and utilize that as an option as well in terms of putting money away for the down payment savings. With COVID-19, there have been some options where you can actually apply for a COVID-19 withdrawal hardship that allows for up to 100% of your assets. Now, that's not typically something suggested, but it's something that you can consider doing. With this traditional IRA, usually as a first-time home buyer, you can take out up to $10,000, and you can actually use that as well for closing costs on your home. Now, with this traditional IRA, you're responsible for ordinary income as well as federal taxes that you're exempt from that early gift. These would typically be the plan A options, if you can plan accordingly for your savings. You can utilize this as a plan B option as a reserve if you need to tap into these options. A lot of people like these tax deferred options because you actually don't have to worry about taking out a personal loan from the bank. You can actually just do the design to pay yourself back. You typically have a 5-year window in which you. The final category is tax-free. With that, this is where you have your Roth IRA, which operates very similar to this traditional IRA, where that money you pay the taxes up front, and you have that same exemption option where you can take up to $10,000 on a first-time $10. So the reason for showing this is for you to really get an idea as to where your money's at before you begin your process, so you know where your starting point is, and then from that point you can really build on whichever this idea is. Or working with a licensed professional like myself or someone that is you're comfortable with, certainly they would know your financial situation and make the appropriate accommodations and recommendations for it. In addition to this, we're now just looking at budgeting, right? The worksheet I provided shows you an itemized illustration of various expenses. One thing that I suggest is to certainly do what's called a systematic investment, where you account for your home buying fund as expense, where it becomes out of sight, out of mind, right? It becomes an easier tool, and it takes out the effort of putting in a lump sum at the end of your monthly expense. It accounts for the actual time that you have monthly expense. So this is really what I wanted to show from the foundational standpoint was to help you as a starting piece. Like I mentioned, this is an evolving list. You can use whenever you like to see where your money is, where your cash flow is, and look at the various investment vehicles, the taxable, tax deferred, to help utilize your strategies for home buying process. On that note, any questions right now, we're going to now, or after the fact, I'd be more than happy to provide any additional insight.
I'm turning up the volume more. Let us know, guys, on the chat if it's getting better. We just started having an incredible echo here at the live side.
Okay. So next up, we will have Manny from Easy Financial. Manny is going to talk about how your credit affects your ability to buy a home and what you can do to repair it. Manny, take the floor.
Thank you, Nikki. Hello, everyone. Manny Moonton with Choice Credit Repair. Thank you to Nikki, Keller Williams, SoCal Group. Thank you, everyone, for allowing us to be here today. What I want to talk about, backing up. So what I want to talk about is jump-starting your credit. A lot of people don't even know where they're at with their credit. So every time I ask, how did you see what you're doing? Oh, credit karma. They always tell credit karma. So credit karma uses a scoring system called Vantage Score. Okay. Vantage 3.0. Nobody uses that scoring system. So are you really looking at things that are not helping you? So what I recommend as a company, this is Choice Financial Course, is going through myfico.com. Okay, when you go to that company, you are actually going through the actual creator of the software that all the banks are using. So now here's some insight. Looking at where you are before you even approach anybody without a hard clue. So you guys know every time you check your credit, it things your credit score, right? But not with companies like MyFICO or Experian.com or even Credit Card. So the whole idea is knowing where you stand now. Jump-starting credit. If you don't know where you're at with credit or what you need to boost the credit scores, we have so much information for you, and we give you all free consultations. Okay? So we'll look at your credit. Okay, we'll determine if you're ready to purchase the home. Okay, some people, they have the money, but the credit is challenged, right? So then we'll look at your credit and we'll guide you on the right ways to fix or clean up the credit or even boost the credit scores. So some people, they say, yeah, you know, I have some collections, they're small, you know, I'm just going to pay them. So I tell them, you know, before you do that, let me look at your credit and tell you if it's right to pay them or not. And people just kind of go, see if it's right. Well, if they're over 2 years old and you made a settlement on collections or charge-offs, and they don't have the literature to or the written agreement to remove that from your credit history pay, you're going to hit the credit score adversely, okay? Because it's over 2 years old. So if you have a negative account that's within 2 years and you made a settlement, it's okay. It's not going to drop your score. So just those little tidbits, knowing that, it can help you create the account. The other thing is, what type of accounts do you need to have on your credit for it to be good for, let's say, a lender for a home, or even a car dealer, or a student loan for that matter, or even building credit with a credit. There's thin profiles, and then there's profiles that are well-rounded. So I'll give you a thin profile. A young college student that has a secured credit card. Okay, they don't even have a car loan in their name. There's no student loans. There's nothing. It's just a secured credit. Well, when a bank looks at that, they're always gonna tell that person, your credit is too weak to rate, so you don't get the post time yes, right? But then you have someone with well-rounded credit, they have car loans, home loans, student loans, they have credit cards on their file, well-rounded credit. It's a very good deal to have this type of credit because your history that you're building is what the banks are looking at to determine if you're gonna qualify. All right. So let's say you need to jumpstart your credit. You don't have enough credit. Well, you have family members that have credit. Credit cards haven't had you as an authorized. So a lot of people are like, authorized user, is that legal? You know, look it up. It is legal, 100%. So if your mom added you to a credit card, is that illegal? Are you like violating laws for her doing that? No, it's just helping you build your credit. If your score jumps up because she did that, is that going to be a plus for you? Absolutely. Because now you have kind of like a financial backing. So when the lender's looking at your credit, they're like, well, they do have some pretty good sized credit cards in their file and they make their payment. Of course, you don't want them to add you to their credit file. So only if it's good accounts, high limit, old accounts. So people will go, wait a minute, can I have a 20-year credit card on file? Yeah, you can. They're not going to look at you and say, you're 19, how could you have a 20-year-old credit card? Okay, it's an algorithm, software. It could be your grandma's card that would have it. So I'll just give you an example. That's how you jumpstart your credit. If you go and get a secured card, right? Because a lot of people tell me, you want to get a secured card. Okay. How much are you going to put on it? I always ask this question. And they normally tell me a couple $100. Okay. So you want to do one thing, you want to buy a house? Well, yeah. All right. So you're going to show the bank that you have $200 to your name and you want to buy a house. And they kind of look at me and smile. Like, John, I go, look, if you build your credit the right way, and I'm not talking if you need to get a certificate, but don't put 200, put 2,000. Okay? Show them that you have money because they know what type of card it is. So when you're dealing with the banks and you're looking, okay, this person's got money, they're trying to build this credit. Let's see how they use it. Okay, and that's where the time comes because getting a brand new credit line or whatever, credit card, it's too new to rate. So you got to use it for at least 6 months for them to start rating you on your credit, especially if you have no credit at all. So if you do have credit, but the scores are not high enough, we even have credit lines that you can get with boost your score 20 to 50 points sometimes in just one. Okay, so that could be taking you from a tier 3 level to tier 1 level. So just do the math in your head. I can qualify now, but interest rate is so high. Well, if your score was this, then you get the lower. So what do you think the investment would be? Pennies for you to get a better rate, so you're going to have that for 30 years. Okay, so you gotta look at those things and start, wondering how the right way to do it. So other than that, there's other types of things that you have to look out for, especially on credit. When you're looking at your credit, you want to make sure that your information is 100% accurate to your information in the pocket, like your driver's license, your social security card, the names that you have, are they matching? All right? It's so important to avoid it, or they just don't know who you're doing. You need to make sure that everything's matching. I had a customer named Maria Garcia. I'm just going to give you an example. I asked her, what's your social? She was Maria Garcia. Let me see it. So she showed me the social and said, Maria Juanita Rodriguez Garcia. So now, I'm not making fun, I'm just making a point. You know how many Maria Garcias there is just in Los Angeles? Okay. Do you think that people's information can mix when they have similar names? Absolutely. Okay. Make sure your identity matches. That's the first dispute I would do with food credit. The second thing, the addresses. If you have a lot of outdated ones, like that, I haven't lived with for 20 years. Why is it on your credit? Because guess what a creditor does when they want to sue you? They don't come to your address, they go to an old address, serve you there. That way you don't know that you have a judgment. but it doesn't show up on credit reports. You have to really be careful about it. Okay, so when I work on people's credit, I look at the names, addresses, our business activities, and I'm looking at how everything's being reported. Any error that I see, that's how we utilize fixing credit. You don't have to lie about stuff. You just go in there and do your job because that is what you're supposed to do on credit. And a lot of people have a right to do it, but they don't know that they have that. They think it's not gonna make any difference. It makes a big difference. Other than that, I don't know if anybody has any questions here about credit or how it's done, but I'll be happy to answer questions
Please.
now, later.
Fire the hard questions at Manny.
Let's do it, everybody.
How often, especially before buying, like how often is that like right before you consider just doing an 85 or what's the best time to do that?
Personally, for the credit repair person, I would look at my credit all the time. Because things can pop up on your credit and you don't even aware of. And then you go into the lender and have it on the credit, and they're like, oh, you can't do anything for me because you have this. And you're like, that was good. I would always be monitoring. That's what I would say. Monitor your credit monthly. You can set up a lot of different monitoring services to even set your alerts if somebody's pulling your credit or something like that happening. Experience on common part. Yes. The number one site that I went to is myfico.com. They're the ones that created the software that all the women are using to run credit. Okay? That's why I recommend it. Not only because they're a good monitoring site, but they give you your true FICO scores before you want to do that. Okay? So I'm not saying avoid lending. No, I'm saying know where you're at before you go in to waste time. So you may have to do that. And then if you have questions or concerns about where you're at, that's where you come in and go do your test. No problem.
Yeah, if you can repeat that question, Manny, when you
Yes.
address that.
The question was, how do you avoid credit repair scams? Especially where somebody already knows that you're timid or desperate to get into something. They prey on you in the sense of, I can do this for you. It's gonna be $2,000 and we need you to pay us now so we can handle that. Right? So no one in the credit industry can charge upfront money for credit repair. It's against the law. Okay, it's against the COA Act, which is the Credit Repair Organization Act. So what you have to do is find out, first of all, if you're gonna do a credit repair, are you licensed? Are you registered with Secretary of State? Are you bonded with the Department of Justice? Have all that set up? Are you bonded with a security bond company? And then registered with the Department of Justice as well. You gotta ask this question because I know you're thinking and don't know too much about your credit. You're gonna get scammed, especially when somebody says, "Oh, I'll do it for 500." It's cheap. Everybody else is supposed to be, 1,000 plus. You're gonna get scammed if you pay them that 500. You need to have them render a service before you pay them fees. Does that make sense? Like you told me who you are or where you are. I'm talking about my credit. I'm gonna pay you money. That's how you do it. All right. I need good ones. Other good ones. Okay. Yes. Oh, you touched on that.
Okay, is it
Okay. Experience boost. For me, okay, it's bonus. Okay. And I'm gonna tell you why, because some lenders are gonna look at it. I think it's going to manipulate the,
We won't take those trades, so you know.
What's that?
Those trade lines we will not take.
I told you that.
Yeah.
So I know that already, and but people don't know that because all people see is my school is all about it is on TV and they give you this jumping ads and stuff like that. But experience is even this like money. How can I get you to stay enrolled in my monitoring system? I'll give you this boost your score, do this, do that. Guys, it's bogus. If you can get added to an authorized user account, you'll probably lose 3 times the amount you'll get by adding 500 things to the community. You get 10 to the 17 points with you. One free one can sometimes get you 70 points. You see the difference? So, and it's like my mom, she's got this, right? My brother, come on, put me in your car just so I can kind of boost my score. Why are they going to say no? You're not going to use their money. You're not going to use their money. They're going to add you a credit card in your name to go to that credit. Now, if they mess up on their credit, it's going to affect you. So you just have to be wise on, hey, are you still asking your credit card? You don't want to get okay, all right, well, we got one more excellent question for Nikki, and then I'm gonna have the other wonderful speaker come on up.
And your rent on time every month, is that consistent? I've been told that if you register for something through experience, that it'll count your,
That's the boost.
it's still, okay, it's all on
So-
the shade.
So, I'm gonna tell you, if you pay your rent on time, it has nothing to do with mortgage price. It has to do with renting. So if you have a good record on renting, and you go try to rent another place, that's the best thing to avoid any type of evictions and things like that. Now, some people have evictions, but they don't show up on personal credit. It might show up in the apartment complex collection, but it won't say eviction on the credit. So I found out that rental companies, they have an eviction portal. So they can pull your credit to find out eviction notice. You know about that? So that's important to know. So then, you know, it doesn't help you more or your FICO credit.
Danny, I have one.
Okay.
Because I come across this with clients all the time who think that they have to pay off all their debt and close their accounts. Can you touch base on that?
Hallelujah. So guys, remember, credit is so important. Okay, when you start off with it, they're looking at the history of your credit, right? So if you close it, you have no history. The credit bureaus are like, you don't have to open it up. What have you done for me lately? Your score goes to 0. You're like, oh, 3 months. What am I supposed to do? Keep your credit cards open. Utilize them, keep them open and active. You can have a credit card now, okay, and not use it. And you've had it open, but it hasn't been used for like 6 months to a year. You can close it and say, no activity, so we closed it. That could hurt you also. So you can see it should be called I love your debt score because they always want you to do that.
Right. And I explain that to people all the time, that I think it's a great question to touch on for people who think, yeah, pay off your debts.
There's another thing I want to mention about that. You got a $5,000 limit credit card, you owe $4,800. Now they say, you know, how much should I pay? You know, well, you maxed it out, so you lost 15, 30 points for your cycle, right? If you went $1 over that limit, you lost another 15 or 30 on good credit. So you're like, they're scoring me down on my good credit, yes, because you're overextended, right? So now I'm going to get to it, and then it says, what do I look for? You don't want to have more than 25% of that liquid cost. If you exceed that, it starts overextending you and your score starts dropping on purpose. So you don't go out and start opening up more credit cards, right? So utilize your credit the right way, only use little by little. And let's say you went to Costco, and you know, it's cheap now, Costco. So you went in there, and I bought milk and eggs. $500 for that. That's how much it is. Right?
Just say, just say.
Just
You know, and now they only look at two.
Right.
Like, what's going on?
Yeah.
So anyway, you go in, you spend the money, it's on your credit card. Now, how much do I pay? My bill says, a statement, it's only $63. No, what's 25% of your bill? Bring it down to that. So what are you doing? You're always keeping it open, active, and spending and paying it right. What are you showing? You're showing the bank who you are and how you spend and how you pay your bills, right? On time and all that stuff. That's what they're selling credit bureaus to all the banks. You're trending data, they call it. So the way you pay is your report card to the bank. So why don't you get that way? That's what they're doing right now. And that's how you're getting offers from different places too. Because they're selling your demographic information to the ones that are looking for you. American Express might not see that. Okay, so wherever you shop, you're gonna get those offers. Yes. So you don't wanna owe more than, I'm gonna say 43% of your debts. So like, most lenders, they can answer that question also for you, but I don't think they can exceed 45%. 50 now, so there's different types of lenders, right? So some of them will say you can only go 42%, otherwise you have to charge the same for another bid. Sorry guys, I mean, you have to look at it, so just imagine wherever your credit is, you don't want to owe too much, you always want to stay at that 25%. To do that, what is that also going to help you with? When they bring all your finances in, like my family was talking about, you're going to add all the different statements, like all your cards, your car loans, this, that, they're going to add them all together, and you're going to see what your debt is. That's going to make or break the deal sometimes. And then the lender will come in and say, look, you might have to pay this one down, pay that one off, do this, do that. That's what we're all for. We're here to kind of help make it easier for you, because not everybody knows like what you know. And if they do want to, I hope that helps make you better. Thank you so much. Thank you.
Right, up next, we're going to have the leader of SoCal Group, our fearless director, Noel, is gonna come up and talk about the current housing market and what that means for first-time home buyers. Take a look.
Yay.
I'm super loud, so you won't have any problem hearing me. If there's too much echo, then let me know on the chat. We have Donna, our Director of Operations, handling the chat and the Zoom tonight. Thank you for joining us on Zoom. Thank you for joining us in person for this year. I'm going to talk a little bit about what the real estate market kind of is for 2023, give you a little bit of a history, and then we'll talk about some of the nuts and bolts about what to expect for your upfront expenses as a first-time home buyer or a home buyer in general, and then what are some of your back-end expenses are going to be so that you're better prepared for the process, as well as some of the protections and the exposure points that we're going to have throughout the process. Let's go through. So what are the benefits of home ownership? If you aren't currently a homeowner, there's going to be some obvious benefits. Building equity, building generational wealth for yourself and your family is an opportunity there to purchase a home and play the long game. And by the long game, it doesn't mean that you have to buy your forever home when you're purchasing your first property. In fact, if anything, I would tell you, that's the best case scenario, but the more realistic scenario is that you start somewhere in order to get into the market to build equity over time that you can then transfer eventually to your current home. And sometimes that for home buyers is 1, 2, 3 properties. Sometimes it's 2, sometimes it's 5, 8. It really doesn't matter. It's whatever your freedom to make improvements. If you're a tenant, you're buying a lot of command strips and 3M things. You can't do damage to your walls. You can't decorate. You can't do things to your property for permanent enjoyment like you can to your home. So there's a lot more freedom in what you can do to your first residence if you own that property. It also means that you're financially responsible to get to that. Tax benefits. There's a huge tax benefit that not a lot of people factor into the equation on what their monthly mortgage payment is. And and that is writing off your mortgage interest, writing off property taxes. Those are some of the things that you get to enjoy as a homeowner that you don't enjoy as a tenant. And that actually reduces your overall taxable income, which means you make more. If you're a W-2 employee, you're gonna be able to claim more of your income because you have additional write-offs. Now, there's some maximums to what you do on an annual basis. And I'm not a tax advisor, that's my disclaimer. Please talk to your CPA or your tax advisor. But I can tell you, and Janelle will touch on it a little bit, is it's a pretty significant amount per month that we're saving potential income tax based on your mortgage interest write-offs and property tax write-offs. So that helps to decrease your total mortgage payment to more of like a net mortgage payment. So if you start up here on total mortgage payment, you still have to write that check and that's the reality. But your actual net, once you file taxes, is a lot lower. Actually, when you look at that final file taxes. And you can even change your W-4 for exemption if you're W-2 employee. You can reduce, or you can increase your exemption in order to reduce the monthly tax taken out of your check. You just don't want to over exempt yourself, so that you end up owing tax. Pride of ownership, I think that goes without saying. So let's talk about the plan. The last 18 months has been a doozy. I've been doing this for 22 years, and it felt like nothing I've ever experienced. I mean, we were in the trenches with our buyers for the last 18 months, from end of 2021 into probably about April. We were just, it was just brutal, Buyers were trying to get properties, they were writing 10, 12, sometimes 14 offers just to try to get an acceptance. They were writing $100,000 over the list price because there was no inventory and the interest rates were so low that the buyer demand was just out of control and there wasn't enough inventory to satisfy the demand. So prices skyrocketed, and that was just the seller's market of the last 18, well, I shouldn't say last 18, but from 2021 into the second quarter of 2022, it was just 100% of seller's market. But cue the interest rate hike of the second quarter of 2022, we saw interest rates go from at the beginning of 3.25, 3%, 2.75 interest rates, like just cheap money, to they started creeping up to about 4, 4.25, and started creeping up. And then they started creeping up to 5.5, 6. And by the time we hit around October, November, they were hitting 6.5, 7%. And the bottom just fell out. We got a bad haircut into prices. So prices, and I'll give you a personal example. I had a listing at the beginning of 2021, February, 1.25 million. We were in escrow immediately, like within hours. And we had a buyer back out on us, like halfway into the transaction. And that's when things started to kind of escalate in regards to interest rates. And then by the time we put it back on the market, made a couple of improvements, put it back on, interest rates had gone up to about 4.5. And we couldn't get that thing sold. By the end of it, we ended up having to reduce the property price about $100,000 in order to attract buyers. And that was just what happened. Overall prices came down between April of 2022 to November of 2022 by about 15% in the Orange County and LA County area. It was fast and hard, but then it was over. And a lot of people have expected that that was going to continue into the new year, and that was not the nature of the market that we're in. That changed, and the market stabilized because we had great jobs reports. The Fed has been increasing the prime interest rate just exponentially. That's where it got so high in the end of 2022. But even though they just increased it another 0.25% this last week, it hasn't been as a negative of an effect on mortgage interest rates as it was earlier last year. So we're now like high 5s, mid 5s, closer to 6s. It depends on your score. So let me qualify that. It depends on your personal credit profile, as Manny would tell you, and Janelle, our lender, would tell you. But that is still not as high as it was. And what we're seeing now is because of the fact that ironically, we still have super low inventory, it's now keeping prices stable. So we'll get to inventory in a second, if you can me on that next slide. We're going into a balanced market. This gives you an idea over the last 12 months, what the months of inventory, this is what we call inventory or months of supply. In a seller's market, you have below 2 months of supply. When you have anywhere between 3 to 4 months of supply, you have balance. When you get into 5 or 6 months worth of supply, you have buyer's market. Guess what? We're not. We're not in the buyer's market yet. And a lot of people think that's already here. So I want to be the first person to tell you it's not a buyer's market yet. There's negotiation room in some cases, depends on how long a property's been on the market. But for the most part, what we're seeing is like in Orange County, we still have less than 2 months supply. We have about not quite 2.5 months supply in LA County. Riverside, 2.5. Your buyer's market is from San Bernardino. So if you want to go live out there, by all means, I would say this is your time to do it. If you want to retire out in San Bernardino, do it. This is the market to do it in. Maybe you want to go buy it in the market. So that just gives you an idea. I mean, we're just not in the market where the supply is enough to meet the demand. Even given the interest rates still being higher than they were. Historically, they're still pretty low. And I've seen interest rates at the 7% and above, doing this for a long time. And people will tell you, like, back in the 80s, I had a 14% interest rate. And that's true. Like, the interest rates are what they are. If you can afford the payment and you can, if it's the right time for you to buy personally, whatever circumstances are right for you, it doesn't matter what the interest rate is. Eventually, the market changes and your interest rate can be refinanced. So it's the old adage you might have heard, like, date the rate, you marry the house, right? Get into the house that you want with an affordable payment for you to buy at the time you qualify for that. Buy the house, you can eventually refinance. Nobody knows for sure, nobody has a crystal ball to know what your interest rate is going to be over the life of the 30 years that you have a mortgage if you want to refinance. No one's going to know what's going to happen with crime. We don't know if the stock market's going to crash. Nobody knows. But historically, interest rates change pretty significantly. And economic forecasts do predict that inflation's getting better. So for 2023, we're looking at better rates as we go into this year. So that's the good news. Let's hit the next slide. This talks about nationally. This was a 2023 forecast from Barry Habib, who is featured nationally all over the mortgage industry. His strategy in looking at what the trends are and what that means for mortgage rates and housing market. So he basically said, again, 2.5% was the reduction in the overall average prices nationally for our area. But look at this, from the last 10 years, the equity has gone up. Prices have gone up, equity and prices. Prices have gone up 115% in the last 10 years. So if you don't think home buying is a good investment, that should be a good indicator that that's your way to build generational wealth. That's where the real money is. 39% in the last 2 years. So a lot of people ask me, are we in a housing bubble? Was this going to be another crash that was going to happen because what was happening with inflation, the cost of eggs, the gasoline, all of that are these economic factors that are indicating that we're going to have a crash? Because I believe I was there in 2008, 2009. I lost my shirt. It was terrible. I was a realtor. It was not a good time to be a realtor. And it was not pretty, but it's not the same. Those circumstances not exist in this current economic forecast. So I would say, now over the last 39% over the last 2 years, people still have a ton of equity. Why there's not a lot of people. They don't want to, they're going to have to go and pay the prices that everybody else is. If they sell their house, they might have all that equity, but they're going to have to pay the prices of right now. So it's not a lot of people want to put their house on the market. So we have really tight inventory. As things start to change, eventually people will have to sell. People die. I will tell you right now, about 40% of our inventory for the last 12 months has been probates, trust sales, People are dying left and right. It's happening, like, our population is aging out of their homes. It just is the nature of the beast. And so that's gonna happen. People get divorced. Boy, after the pandemic, there was a lot of people like that. So those are factors that happen. Like divorces, marriages, deaths, divorce, all of these things create movement when we talk about property. And so I will tell you, I don't expect that we're gonna be dealing with a lot of foreclosures, although foreclosures have gone on the rise. They've come up about, I think it was 19% in LA County just in the last maybe 2-3 months on foreclosure starts. But those are people who are in the beginning of it. And the foreclosure process takes forever. But technically, it's only supposed to be like, you're delinquent on your mortgage and in 60 days you go into the foreclosure, you get a notice of trustee or notice of default. And it's another 90 days, you get a notice of trustee sale. But that gets dragged out. So I've seen people who go through 18 months, 24 months sometimes, they're trying to work out plans. We're too far away from the foreclosure market for that to be a significant part of our inventory anytime in the future. So, given that, I would say it's low inventory. Set your expectations to be realistic. It's absolutely a time where you can negotiate more easily as a buyer than you could have in the last 18 months. Buyers were like giving their firstborn away in order to get into a house. It was just ridiculous. So now you can make a reasonable offer. You don't have to remove all of your contingencies up front. You can do an inspection. Like, how crazy is that? People were waiving their inspections and just buying houses buyer beware. I've never recommended that, by the way. But they were waiving appraisal and they were paying over the appraisal value. And that was dangerous territory. So in the current climate, we're going to talk about outlining contingencies that protect you. We're going to talk about what to expect as far as the total amount of upfront investment, I guess, therefore. And we're going to talk about how you kind of look at how to determine your purchase price. Being prepared for what closing costs are going to look like. And then what is an escrow in general? How long is that period? What would be your expectation for the time that you start looking for a home from the time you get your keys? Allocation costs, who pays for what in an escrow transaction? And then making sure that your exposure points are needed as far as when are you as a buyer at risk of losing. Go ahead. You're going to make an offer. You're going to have to open an escrow, get an offer accepted by a seller. An escrow is the period from the time that you have a seller ratify your contract, sign and say, I accept this offer, and both parties agree. You have a written contract, take it to an escrow company. And escrow is a third-party company that's going to facilitate the sale. They're the ones that handle all the money. They take in the money from the buyer's deposit. They issue the money to the sellers, and they get their proceeds at the end of the sale. And they're the third-party licensed, insured, bonded in order to handle that transaction. That's an escrow transaction. It's from the time that that date stamp where you get the accepted offer to the time that the grant deed gets recorded at the county recorder's office saying that property is now yours. That's the final date of closing. You can't close until that happens. Did I cover that? Yeah, they get the contract. Oh, the EMD. Your EMD is your initial deposit. That's called an earnest money deposit. An earnest money deposit is an upfront, it's like flash cash, reserving like a holding deposit. So if you're making an offer on a property, you're going to make including an amount towards your earnest money deposit. And that typically in our industry is anywhere between 1 to 3%. 1% would be a minimum standard. Typically sellers, especially in a low inventory market, are going to be expecting that you're going to have more skin in the game in order for them to feel that you're a good risk. So you want to do around 2 to 3% as an earnest money deposit. If you have a good agent, anyone on the team, myself included, you're going to make sure that that deposit is protected by contingency. You're going to have certain contingencies. We'll talk about that soon. Go ahead. Inspection period. That's the first. That's most important. So when you write an offer, as a buyer, run an offer to the seller, you say, hey, Mr. Seller, here's my offer, here's my deposit, this is the purchase price, and I am making this offer contingent on an inspection and my approval of the condition of the property after an inspection. You hire a professional inspector. We can make recommendations for you. Anybody else you don't think is a recommended professional or you vetted a professional, by all means, use whoever you want to use. But inspectors aren't licensed. They are insured and they're certified. You can find an inspector who's certified, and I would highly recommend that. But you want to make sure that they produce a written report that is extensive, showing you health and safety concerns, showing you a breakdown of what meets code requirements, really giving you the A to Z on the condition of that property, so you know what you're getting into. Secondary inspections are going to be things like if the physical inspector comes out and says, okay, we've looked at everything from structure, electrical, plumbing, roof, everything about the property. Now, we saw that there are some things that aren't right here, but we're not qualified to tell you what's exactly not right and how much it's going to cost to fix it. You might have to have a secondary inspection. This could be like the water heater's honking out or it's making noise or something's wrong with it. You're going to want a plumber to come out and evaluate what that problem is in the secondary inspection. The typical things are like foundation problems, roof problems, plumbing and electrical issues. All kinds of things come up on secondary inspection. So those are things that you do during what we call an inspection period. An inspection period can be anywhere between, I've seen them as short as 3 days, which I don't recommend. 3 days to 17 days, which is the default that we have for the park. Inspection costs are your expense as the buyer. Be prepared for that. You're paying that deposit up front, but that's going to go towards your down payment. But these are out-of-pocket costs. So your inspection is going to cost you about $400. If you do secondary inspections, the sewer scope inspection is about another $400. Sometimes $250, $300, but you get what you pay for. So you want a good inspector, make sure that you select a professional who has the right equipment to produce a video report, whatever you need, or pictures, and give you an estimate of cost. So you're looking at anywhere between $400 to $1,000 for inspection. And then your second contingency is an appraisal. Your appraisal protects you as the buyer and your lender by making sure that the property is worth the amount that you offer as the price. So let's say, for instance, you find a house that you love and the list price was $750. You offer $750 for that price, so for that property. The seller accepts it. You put in a contingency for the appraisal. That means you're telling the seller that the property has to meet the standard of $750 as the appraisal does. So if the appraiser comes out, and this again is something that's actually not within your control as a buyer, the lender selects the appraiser, and it's not even them specifically that selects the appraiser. They select, so it's like what we call an arm's length distance transaction. So they select an appraisal management company who then selects a certified and licensed appraiser who comes out and does the appraisal of the property and reports back to the lender, yes, I feel the property's worth $750. And they come and inspect the property. They're not checking like a physical inspector. They're taking square footage measurements. They're making sure that the property is not falling down. You know, it's not in disrepair or whatever condition might exist. They want to make sure that that property is worth that $750. So let's say, for instance, they come back and they say it's not worth $750. If that's the case, what happens is you've got a point of renegotiation. You had an appraisal contingency, and they came back and said property is only worth $700. Then you as the buyer go to the seller and say, "Ooh, we got a problem. Property only appraised for $700,000. Here's a copy of my certified appraiser, and it didn't appraise for $750. It only appraised for $700." Typically, you're going to have one of two things happen. You have a good agent. Your agent is going to help you request either a price reduction to the $700 so that you can move forward quickly through the transaction. We're producing that report to prove that this is not you saying the property is worth $700 appraisal. Or if the seller's going to tell you to pound sand and they're going to go to a backup buyer, that might be willing to pay the money. Or somewhere in the middle. So let's say, for instance, you'd be willing to come in with the cash on top of the $700 value for the appraisal halfway, like you'd be willing to pay $20,000 on top of the appraisal value. if they'll come and bring down the price $30,000, the price is now set on front, and that can happen too. As long as you have the capital to cover that difference. If you're putting 10% down, let's say for instance, on that 750, you still have to put the 10% down on the 700 appraisal value, plus the amount on top of that you're paying. Because the lender will only lend based on the appraisal value. Your down payment is based on appraisal value. So that's where that contingency comes in. If you can cancel the buyer, if it comes in and the seller doesn't want to reduce the price and you don't want to come up with a difference on top of that, you can walk away when you get your deposit back. Same is true of the inspection. If you find out that the property has major issues with it that you don't want to have to pay out of pocket for, and the seller won't repair those things, you get to walk away and keep your deposit. You're gonna lose the cost of your inspections. You're not gonna get that back. That's fee for service. The inspector did their job. They came out and they, produced the inspection report. Same with the appraiser. The appraiser is gonna cost you $600 typically. If it's an investment property, it's more expensive. But if it's a typical house, condo, it's about $600. You're gonna pay that out of pocket and you won't get it back if the appraiser doesn't. But it will have prevented you from overpaying. So cash to close, we talked about upfront costs, your initial deposit, your inspections, and your appraisal. Let's go to cash to close. In addition to those upfront costs, that deposit carries over to anything that you owe at the end of the escrow period. 30-day escrow, your deposit goes in within the first 3 business days after you get an acceptance, typically. Then, at the end, let's say you're putting that 10% down, that 2% is going towards that 10%. So you have to bring in the balance of funds of the down payment plus closing costs. And not a lot of buyers are aware of what closing costs are. They're all the third-party fees that get created during the transactional process by third parties and because of the lender and what their costs are, especially if you have anything less than 20% down and you have to have what we call prepaid accounts for property taxes, homeowners insurance. There's a certain amount that the lender has to make sure that they collect upfront. That's all tacked on to the total cash flows. So closing costs can vary by loan program, depending on whether you're doing an FHA loan, EA loan, conventional loan, specialty loans. It depends on the lender too. It depends on how much they're charging points. See if you're trying to buy down an interest rate. They vary so widely, I couldn't even pretend to tell you what your closing costs are. So you've got a quote from a lender. So this is why it's crucial that you are well prepared and pre-approved before you start looking for a home. You need to know what your budget is for not only the purchase price, but how much cash out of pocket you need to be prepared for to come in with closing costs. So down payments can range anywhere as little as 0% down, i.e. EA financing. 20% down would be, a best case scenario or more. FHA requires 3.5% down minimum. There are some other loan programs out there right now that are specifically geared to first-time home buyers. And those are sometimes with 0 down and no mortgage insurance. Those are specialty programs where you have to qualify based on income limitation. So if your total household can't make over a certain amount of money, depending on the county. If you want more information specifically about some of those programs, you can DM us and we'll send you the recording of this link. For those of you who are here, we'll send an email to everybody just to make sure that you have access to some of that information. Janelle will share some of the information that she has. But some of these programs allow you to look outside of what's traditional. And then closing costs in general, if it's just basic closing costs and you're not paying down interest rates, you're not doing that, you're going to look at anywhere between 2 to 2.5%, sometimes up to 3% of the loan amount. So if you're putting a 3% down payment, you're also going to have potentially up to 3% for closing costs. So you better make sure you've allocated that amount of cash. I can't tell you how many times I've had a buyer come to me and say, save my down payment, I put 3% down. I'm like, great, are you ready to pay your closing costs? They're like, what is that? And that doesn't mean that we can't purchase, but we have to be aware of what our limitations are going to be, how we're going to structure our offers. We make an offer to a seller, you can ask the seller to help you pay your closing costs. You can ask for what's called a seller credit. And that means we're gonna be basically asking the seller as a concession of the sale in order to accept your offer to help you pay for your closing costs. And sometimes sellers are willing to do that. It's gonna be on a case by case basis. It depends on the motivation, how long it's on the market, if you have competition. All of those things are gonna factor into whether you're successful in negotiating the seller closing cost credit. But I can tell you, in this market, it's really, as we start getting into this spring buying season, we're gonna see a lot of competition. It's gonna be harder to get those credits paid by the seller unless maybe it's been on the market for a while. So the longer the property's been on the market, traditionally you have a little bit more room to negotiate those types of things. But sometimes it's right out of the gate, but it's gonna be again on a case by case. So we talked a little bit about this. One of the things that we wanted to bring to your attention, just as realtors here in Erie, we have a couple of specialty programs. In Long Beach, they have a down payment assistance program that they just announced that they had allocated about $2 million for, that they're giving out. Now, there have been, I think, Andy, you said it's like 3,000 applicants already, but not everybody is going to qualify for really strict qualification guidelines. That they're giving away $20,000 grants towards down payment. And that's a big deal. If you're a first-time home buyer and you want to purchase it within the city of Long Beach, there's specific areas where you can purchase and where they qualify. So it's not only you personally that have to qualify based on income and some of the other restricted guidelines that they have. The property itself has to be in specific geographic areas and it has to be in Long Beach. But there's also programs like NACA. That's can't remember the acronym of what it is, but that basically is encouraging homeownership in areas where, or demographic areas where there has been less homeownership overall. And this opens up a program where it's national, it's a national program that encourages homeownership in those areas where they're lower and moderate areas. And again, it's going to be based on household income and whether or not. So these are some of the programs that exist, but then we also have some really creative things. Because the interest rates are still high, there's some creative ways of doing mortgage financing with good old fashioned conventional mortgages, FHA, VA. You can actually buy down your interest rate by paying a little bit more in your closing costs to get that rate down. So for instance, if you have put in 6% interest rate, but there's some options to buy down that rate through the lender's pricing options, you could pay 2 points, 3 points, whatever the buy down requirements are, to get that interest rate down to like 5%, sometimes 4%. We've seen some pretty great buy down options, which Janelle will talk about, that make it so much more affordable for you as a buyer to be able to get into a home right now. Is the difference of hundreds of dollars a month in the buy down. So the upfront cost may be worth it if the savings over time they got worth it quickly. And that's one of the things you'll have to gauge. That's it for me. I'm going to let Nick introduce our next speaker. Does anyone have any questions for me? Okay. It happens a lot. Sometimes, let me give you an example. What the appraiser's job is to do when they go out there, the lender is hiring an appraisal management company, the selecting appraiser is going to come out. All they're trying to do is meet the standard of the price that's indicated. So they have a copy of the contract. They know what the price is that they're trying to achieve. And you'll usually see, I'd say most of the time, maybe more 80% of the time, that the appraiser will say, yes, this property is worth $750, not a penny over. They're not giving you an appraisal value over. And so it's not a bad thing if the appraisal comes in immediately at the exact same value. That's what they're trying to do. Manage.
So that has a lot to do with the comfortable.
Yes, and so to that point, you shouldn't get into a situation where that's an incredible surprise. If you're working with a realtor, you have access to comparable sales. And whoever you're working with when helping make an offer is going to engage you. Where are the comparable sales in the area? Does this price, this listing price, stack up against those comparable sales? If you see a red flag that this $750,000 home is the most expensive thing that's sold by $60,000 in the last 12 months, there's a problem there. You're gonna have an appraisal issue. And so you want to, as a realtor, counsel your clients to say, this is kind of what I see the comparable sales supporting in the value. If you wanna make the offer, by all means, but we may have a problem. So that if you get into this, just know that $600 you're spending on the appraisal could either help you or you could lose it. You know, you could go one way or the other. Sometimes it happens that they come in marginally low. It could be the difference of $10,000–15,000, which is a lot easier for us to bridge the gap with the seller. But I've had some come at $60,000–70,000 lower, and sometimes it's due to things that don't show up on public, where the square footage is there, and that's a big deal. If it's not permitted square footage, cannot include it in the appraisal. So if it's advertised as a property that has 1,600 square feet, but the permitted square footage is only 1,200 square feet, you can't count that additional 400 square feet, and that's gonna be a big difference in appraisal value. And so that's where we see the biggest disparities, when we have inaccuracies, where the property is being correctly marketed, or the appraisal is good. Sometimes those can be correct, but not always. I rarely see it that I had one this last year, about the last 3 months, where the appraisal value comes in skyrocketing the entire above the purchase price. And that's in a situation where I had a buyer who was buying a trust sale, and this property was gross, like really gross. I can't even describe it, but he knew, like, he wanted to come in and purchase it, and it was just enough where he as a owner occupant could buy it and fix it up while he was living there, because he wasn't afraid of that type of project. But it was too expensive for cash buyers to get a margin to flip it. So he purchased it at, like, it was $1,015,000. And the value came in when we got the appraisal at 1.1 times. And I was like, boom, you just got instant equity. That rarely happens, but sometimes it does. Most often, they're trying to just meet that.
Thank you so
That's it
much.
for me.
And our last guest, certainly not least, is Janelle with J&J Financial. She's a senior mortgage advisor, and she's going to talk to us about the ever-changing interest rates, buyer implications, and financing to buyers. Take it away. Thank you.
Hi, everybody. Thank you for having us here. I brought Adam up here with me. Adam is my down payment assistant. So anything you ever want to know about down payment assistance, this is your guy. So I wanted to touch one thing about that appraisal question, because it's a great question. And a lot of the questions lead back to why you want to pick the best team, and that includes the real estate agent's preferred lender, and all of that, because your real estate agent, if you see a house that you like, and that house might be listed in $750, your real estate agent, the very first thing she's gonna do is pull in comps on that property. If she sees the comps predominantly in the $700,000 range, the two of you are gonna sit down and have a conversation before that offer is made. Somebody like me might get brought into it if you have a higher down payment, because there's ways that we kind of shift those numbers, so you don't have to come in with as much as $50,000 to make that purchase, but it's still something that you're gonna know up front, and you'll have the ability to make that house is actually going to be or not. So, so I'm Janelle, this is Adam, we are the Sagan team. You can go one more. Want to get into, quick screen, sorry if I stutter on my words. So I want to get into a couple things, and a lot of things that Manny already talked about, so I don't want to spend a lot of time on credit stuff and all of that, but I do want to give you guys an overall understanding of what creates a FICO score. So a lot of people think that FICO scores is like, hey, I make my payments on time, why is my FICO score 650? Well, you might be overexposed, you might have too much debt, you might have things like possible lending limit on a credit card of 5,000 and you owe 4,900. That's going to drive your credit score down. So that is what we call capacity. So capacity makes up about 30% of your score. So again, Manny covered all this. So if you have any questions, Manny's your guy, because if you call me and you have questions, I'm gonna send you to Manny anyway. So you can go to the next slide. Manny and I have been working together for a long time, so he is my absolute trusted resource, to all things credit. So you're, thank you. So do's and don'ts, this is huge. So getting prepared to buy a house, there are a lot of things that people do that don't realize they should not be doing, okay? So obviously you want to continue paying your current mortgage payment if you own a home, or your rent. That's obviously the most important. As Manny touched on, rent can't necessarily hurt your credit. The only thing it can hurt is your ability to go and rent something else. But obviously, if you have a mortgage payment and it's not being paid, you go 30 days on that, you're gonna be very restricted. If you can be lent to at all, you go beyond 30 days, there's no loan out there for you. Okay, so that is huge. Staying current on existing accounts, car payments, credit cards, all that stuff. Pay your bills is basically. Now, you don't have to say you have a $25 minimum payment on a credit card, but you're making $500 payments. But you're trying to save up for a down payment. Somebody like me is gonna say, go to the minimum payment, continue making that payment on time, put the rest of the money in savings, and then we can sit down and discuss what the best options are with regards to your continuing to save money. Continue living at your current residence. So that one doesn't really, that's kind of an old one. So this is a big one. Be prepared to source all your deposits. Okay, so anything that goes into your bank account, we have to address, okay? Especially if it exceeds 50% of your gross income. We have to not only explain what it is, but we have to verify what it is. So if somebody said, hey, I'm gonna give you $5,000 to help you purchase a home, and we see that $5,000 deposit, and that $5,000 exceeds your gross income, we're gonna say, what is this? And you're gonna say, oh, parents were trying to super sneaky, give me a gift to help buy property. We're gonna say, that's great. We can use the gift, right? But is it cash? Yes, it was cash. Okay, well, now it needs to be seen. Okay, we can use gifts from family to explain what they are. If you got a loan, and like an unsecured loan to purchase property, we're gonna have to get super creative with how to get around that, because there are certain rules and regs around that. So be prepared. If you ever have a question about what you should be sticking in your bank account, call a lender. Lender will tell you, yes, you can put that in. No, don't put that in. Let me figure out how we can work those funds into the transaction. Don't do anything with those funds until I tell you.
You know, can I ask?
Yeah.
How long is these seasoned funds?
So seasoning funds means that they sit in your account. Okay, mattress money is a great example. I got 10 grand under the mattress and I want to buy, I'm gonna go and I'm gonna put that money into my bank. Well, wait a second. Anything, what's the minimum deposit before the bank has to, I think it's 10,000. 10,000. So you get a $10,000 cash deposit. The bank is gonna automatically report that to the IRS. Okay, so maybe you want to do that in two different deposits. So you go 5,000 one month and 5,000 the next month. Hold on. Okay, so those deposits have to be seasoned, which means they have to sit in your account for 2 months. Okay, normal banking cycle pretty much means that it's going to be 3 months before you see 2 months of those funds in your account. And if you do them 1 month apart, you're looking now at roughly 4 to 5 months before those funds are seasoned. Does that make sense? Okay.
You can't buy a house for 4 to 5 months.
Yes, yeah. So you want to be careful. So what I would do, if you called me and said, hey, I have $10,000 of mattress money, what I'm going to tell you to do is give it to your mom and then have your mom gift it back. Okay. But again, we're going to want to walk through that process because there's very specific steps in order to do that correctly. so that we can utilize those funds for you to purchase money. Lenders don't like cash. I had, this is one of the funniest, this was when people were copying things and faxing them to lenders as, we just get fax upon fax for conditions and stuff. The funniest fax I ever got, and it was from an escrow officer. And she sent it to me and the cover sheet said LOL. Actually, no, it didn't say LOL. I don't even know if that phrase existed when this happened. I think she just said ha. And it was 10 pages of photocopied $100 bills that somebody brought to escrow as a source of their E&D. Can't use that. Yeah. So nobody likes that. I already said it. Always consult your loan officer with anything you do. Money. That includes transferring. Try to avoid transferring money, even if I do it, I'm guilty of it. I transfer from savings into checking because I keep a very low balance on my checking account. So when bills come in, I transfer the money into my checking account and pay my bill. Well, if I were to go get a loan, I would be tracking every single one of those transfers. Okay, especially if you're transferring from B of A into your Chase account, what I do. Okay, because if it's Chase to Chase, that's very easy to track. But two different banks, you gotta remember that every transfer in and out of your accounts, you're gonna be asked to source it. Okay?
I wanted to touch on the, when somebody gets, let's say, a first money without paying.
Mhm.
If that first one was under credit, it's gonna drop your credit score. So, because, yeah. So, if you're at a store where you can qualify and then all of a sudden you got a 50,000 foot store loan, they put that on the credit, your score just dropped out of 50 points, and now you might not qualify. So you gotta, the gift idea from the parents is the best I can think of.
That's enough.
Yeah, the gift idea is the best.
Yeah.
Um,
Or like, don't buy a car.
Yeah, don't buy a
lot
car.
of people-
Yeah, I think that's on the, yeah, we haven't gotten there yet, yeah. So, yeah, so alert your lender if you had a client who was switching jobs, okay? We were in escrow. She was a lab tech. She did she ran medical labs. She was like, oh, this shouldn't be a big deal because I'm going from this job where I made $19 an hour to this job where I'm making $22 an hour. Should be okay. It wasn't. Just before we were pulling for final loan docs to close for loan, we do what's called a verbal verification of employment. Her old job said, no, she no longer works here. We're like, I called her, she was like, job, this is where I work. I said, I need a pay stub, I need this, I need that. I got a pay stub, and on her pay stub, it reflected part-time hours. And she said, no, it's okay, I work 80 hours. I said, you don't have any history of working 80 hours at this job. Completely kills her income. Yeah. So always, any big things that come up, just let us know. We can, 9 times out of 10, we can work it out, or we can tell you, wait a couple weeks to make this big change, or we can, help you through the process.
So what if she was a lab technician?
Mhm.
But now she's gonna be working at Target as a manager because she's making more money. Has 2 different job descriptions, what's gonna happen to?
As long as she goes from W-2 to W-2, and she has a good offer letter and all that, she would actually be okay. Okay, unless she was relying on overtime or bonus to subsidize her income, yeah. So if she was going from straight W-2 income or straight hourly income, $19 an hour, she goes to Target, even though it's a change of industry, she's already got a 2-year history of working, she's fine. And as long as she's making 22 hours at Target, working the same number of hours, she should be fine. Yeah. So some big don'ts. Don't make major purchases. Manny just said it. Don't go buy a car if you're trying to buy a house. Don't apply for any new credit cards. So we're still in an inquiry or the FICO. Okay. And if we see a new credit card on the credit report that we didn't see before, now we're gonna have to go into explaining it. Do you owe anything on it? You gotta prove that, all those fun things. Don't transfer any balances from one account to another. I already went over that. Don't quit your job. Don't close any credit accounts or change bank accounts. Okay, we kind of went over that when Manny was talking. If you close your credit accounts, you lose the history, which will lower your scores. And don't run your credit before asking, your loan officer. Same thing. No run. Okay, go ahead. Okay, so I want to go over some very basic differences between direct lenders, banks, and credit unions. We're a direct lender. Okay, so when you work with a direct lender, you're gonna get the speed. So when Noel was talking about contingency periods and making sure that you met those periods, your direct lender is going to make sure that all those timelines are met and can get creative and very aggressive with those timelines. If it is the difference between you getting your offer accepted and not. Typical contingency periods are like 17 days. We can lower them to 8 if need be, cut them right in half. And we would do that if you're in a situation where you have multiple offers, right? And those multiple offers are starting to get aggressive and you just kind of want to make your offer stand out. So it's a great reason to work with a direct lender is the speed. We're experienced, okay? I've been doing this for 25 years. And you want experience on your side, especially when we're in a market that we are. I like that you call it a balanced market. I call it a hybrid. But it means the same thing. It means we have this balance of benefits. Balance for sellers and balance for buyers. We have more negotiating power for buyers, which we haven't had in a very long time. But we still have very low inventory. So that puts the sellers right there even with the buyers. Flexibility I already talked about. We have the ability to broker. So if you have a scenario that doesn't fit into a mold, we have the ability to find a lender who can do the loan for you. We're fast, I already did that. We're relationship driven. Banks and credit unions are risk driven. I'll go into that on the next slides. We are relationship driven. The reason we're relationship driven is we want to be your lender for life. When you purchase a home, I want you to call me when you want to refi. When you have a baby, I want a baby announcement. Okay, we are relationship driven. We are here to help you throughout your entire life of owning property because we want to help you build that wealth. We typically have a better reputation because we're relationship driven. That's pretty easy. But we have higher rates. That's just the long and short of being a direct lender. And I don't mean, you know, fraction. Yeah, it's fractions. It's 1/8% to a quarter. But for somebody to answer the phone on a Sunday night, when you're freaking out about your purchase or something's happened and you need somebody to answer a question, that 1/8 to a quarter percent is very much. Okay, next. It depends on the job and it depends on how that job is worked out. So if you go from, I've had people go from being W-2 employees to stay with the same employer, but go to like a contracted status. That's bad. So it totally is determined by the situation, but that's why you need to ask. Typically that's going to be fine, but you just need to ask. Okay, so credit unions. The best thing about credit unions is their member benefits. Okay, so if you're already a member, great. If you're not, it might cost you $25 to $50 to open up a checking account to become a member. Credit unions are going to have the most, their guidelines aren't very flexible, but they create loan packages for their members that sometimes direct lenders can't do. They're aggressive and they're specifically designed to bring in more members, basically. They're not very flexible guidelines because the more out there that loan package is, the more risk it presents to the credit union. So they can't have a lot of flexibility there. The biggest thing about credit unions, which goes back to your appraisal question, is they are very conservative. I can't even tell you the number of loans, I call them rescue loans. The number of rescue loans that we get, which started with the credit union, appraisal came in low, was gonna kill the deal. The deal came to us, we appraised it, no problem at all. Okay, and remember, Noel touched on it, we hire a management company that hires the appraiser. I'm not calling my Uncle Joe saying, hey, do me a solid and appraise this property, right? It's all third-party relationships, so credit unions are kind of known for bringing in value a little bit more conservatively than a direct lender. Excuse me, slower turn times. They just have slower turn times. They work bankers hours, they're gonna close at 5:30, you're not gonna go back to Monday. They do not answer your calls. They do not answer your calls on the weekends, yeah. All right, banks. So banks are gonna have lower rates. This is what it is. We get shocked by, clients, well, I just pulled up B of A and you're quoting me 6.5 and they're quoting 5.5. Usually it's because they're adding 2 points or something to it. It's an advertisement. People very rarely get what they're advertising, but one of the reasons that banks can lower their interest rates as low as they do is they have multiple streams of income. So banks right now in markets like this, where mortgage applications are actually down a little bit, banks do what's called buy in the market. They lower their rates and they operate their mortgage divisions at a loss. Because the car loans, the installment loans, the student loans, the financial platforms, the savings and loans can keep them afloat while their mortgage divisions are either operating at operating at no, at no gains, sorry. Sorry, the extra's killing me. Yeah, they're either breaking even or they're taking a small loss. So that's kind of what banks do. So the cool thing about banks though is if you have enough money, you can work with their private bank. What that's going to entail is you depositing. I think it starts at about 500 grand and goes up to $1 million. You deposit that into a private bank and let their guys play around with it and invest it. You can get access to any number of loans that nobody's going to touch rate wise or program wise. But again, that takes quite a bit of money to be able to do that. Banks have very aggressive jumbo lending. We as direct lenders, we have a portfolio of jumbo loans that we do in-house. The rest of our jumbo loans are all big banks. We've got B of A, we've got Citi, we've got, we used to have Union, we used to have Wells, we don't have those anymore, but we have PNC, we have a lot of big banks because their jumbo products are going to be the best on the market. Okay, disadvantage is they have inexperienced loan officers. One of the reasons is they don't pay their loan officers very much. They probably pay their loan officers half, sometimes less than what people like Adam and I make. And which is why they're not going to answer your call on the weekend. They're not going to really put in that time. Usually what they'll do is they'll stick, oh, I got my license. They'll stick them in a branch. These people will sit in the branch and just wait for loan applications to pour in. And unfortunately, the pull-through rate on those is about 25%. Yeah, that was shocking. Yeah, and there's a number of reasons that is. But a big portion of that is because the LO is not as experienced and doesn't know where to put them and what programs to put them in. There's absolutely zero flexibility. Here's a box. If your pinky toe is outside the box, you're done. They have processing centers that are all over the US. So you could walk into a branch that's down the street, but you can have a processor that's in Texas. And that creates a time difference, which is going to create some stagnant and slower turn times on the processing of your loan. Same thing with appraisals, and customer service takes a back seat. I don't tell you this, but customer service with a bank takes a back seat to this. Always. It's too risky for the bank. They do not go. They don't care if they are getting ready to fund your loan. They will cancel. The risk becomes too big. Okay, I'm gonna let Adam take this. You tackle that.
Well, the first time. So there's a lot of first time when my
Probably the biggest and, one that a lot of lenders will use is Alhambra. So skip on over to the Alhambra one. It's a great program. It's a California run program. They've got a lot of different down payment assistance, closing cost options, but I think Noel was talking about it earlier. There is FICO requirements. There are requirements as well. Kind of the four main requirements here is US citizenship. Okay, you kind of see eligible buyer must be either a citizen or national of the United States. You do have to be a first-time home buyer. Now, a lot of people misconstrue the meaning of first-time home buyer. They think, oh, I had a house, 10 years ago. I'm not a first-time home buyer. Well, the true definition of first-time home buyer is you haven't had ownership in the last 3 years. So if you had a property and you sold that in 2015, and you haven't had ownership interest in the last 7 years, you qualify as a first-time home buyer. Yeah, a lot of people don't know that. I don't. Yes.
You said, Adam, that it's store driven. So what store are you talking about? Where do they have?
Yeah. On the low end, it's 640. 640, you're looking at a Calhapa FHA or VA. On the higher end, the minimum is 60. So those are your conventional.
So like, if you're gonna be over like 720.
Yeah, 720, yeah, you would be more than qualified, you're good on that. But on the low end on there, you can go as low as 640. You can go 660 with a conventional, if you have to move 80% of the area median income. So every county will have a income basically, and that's 80% of that overall average. Okay. Income for LA County is you can't make more than $100,000. Orange County is $235,000. Household. Yep. All
And
inclusive.
that's just one up.
Yeah. And every year you'll see the adjustments. They just increased it. Well, it's the middle of the year. We do it right at the end of June. They'll increase kind of the area median income numbers. They'll also increase the owner occupancy. Your investors cannot use this program. It has to be your primary residence, and you have to move in 60 days after closing. Okay. Excellent. So when you do these Calhapa loans, there's really two main, I call them down payment and closing cost packages that we can have. The My Home is probably the simplest, probably used the most because it has the flexibility to go both down payment and closing cost assistance as well. Whereas the second one, the Cal Plus and Zip, strictly closing cost only. It's a deferred payment, so it's essentially a second loan on top of your first, where it is deferred. It is repayable upon sale of property. It's not free money, not forgivable. How we used to have it forgivable. Or if you have a refi or there's any title change, well, that loan will be called due. It's a low interest rate. This morning I looked, has been 1%, so very, very low compared to what we're at today. Must be a first-time home buyer, and talked about must be primary residence as well. Okay. The Cal Plus is essentially the same exact thing. And real quick on this one, you can use 3% if you go conventional, or 3.5% if you go FHA, and it's the lesser of your appraised or the sales costs. So it's always going to go the conservative route. Now with Cal Plus the Zip, it's a 30-year fixed interest rate. You can take advantage of a 2% or 3%. So they've got two different tiers in there to essentially utilize towards the closing. It's a zero interest junior loan, so similar to the My Home on there. It's typically in the third, so you've got the second being the My Home, the third being the closing costs. And the great thing is you can package these things together. So you can have a My Home that covers an FHA, 3.5% down payment, get a 2% zip loan as well, and essentially you've got 5.5% all covered to assist with both down payment and closing cost assistance.
Hey, Adam, go ahead, sorry. Is there a minimum requirement anymore for buyers on this? I know it used to be buyers would come in, all these numbers, how they worked out, the buyers would usually come in with roughly a half a percent as their portion. Is there a minimum requirement?
Typically, it's about a half a percent all the way up to a 1%. Now, I say typically, last year, Alpha had a very unique program. It was a forgivable equity loan. The state had to put aside $80 million for people who wanted to essentially get a loan. And that would cover, you could come in with zero. I mean, it was great. November got notice, all the funds have been used. Bye-bye, it's no longer. But I use CalHAFA because there are a lot of lenders that will have maybe more flexible guidelines. All kind of follow them to the CalHAFA because CalHAFA is kind of a big dog in California, but more flexible in terms of maybe income. Some of them will have a forgivable option. So there are different lenders out there that will have different programs on there, even though CalHAFA maybe not have nothing. So this isn't the one all be all, like Noel was talking about, there's local municipalities. Long Beach has got one. Different cities will have one, different counties will have one. So it all can, there's a lot out there.
And I was just gonna ask a question, Dan, for the PMI.
Yes, so FHA is pretty standard with their PMI. You can actually get a reduction in PMI with CalHAFA. If you meet 50% AMI, the area median income on there, we take half of what we typically charge, which is great, absolutely. But it's kind of a catch-22. You can't make too much money, but you have to make just enough to qualify. And and they were adjusted their debt to income requirements as well. It used to be 45. We've got a FICO score of 700. And now you go to 50, which is great. That wasn't there before. That extra 5%. Typically, what I tell you is get into it, and then exactly, yeah, and then refinance out of it. That's exactly what I did in my first home. And refinance out. Go. All right.
Okay, so, Noel touched on this, and it's really important to understand the various incentives that, are out there to help us lower these incentives. So one is the 2-1 buy down, which I think you have on one of your slides. So how a 2-1 buy down works is we'll do a regular pre-approval, okay? And say their lockable market rate is 6.5%, okay? The 2-1 buy down allows us to lower that 6.5% by 2% the first year and by 1% the second year. So the 6.5 would turn into 4.5 the first year, 12 payments. And on the 13th payment, it would go to 5.5. And they would make 12 payments. And at the end of that 12 months, it would go back to 6.5. Okay. That's great. It allows people to get into these properties, with much lower payments, right? Yeah. With the idea that we are going to be going into a lower rate environment, so we'll be refinancing them out of that loan before it hits that 6.5, or at least being very strategic in the sense that if at the end of that first year, if I'm seeing market rates of 4.5, I'm calling that client and I'm saying, hey, let's get you into this 4.5 permanently before it turns into 5. Okay. No. We like 6 months. There's no prepayment penalties on any of these loans, but from a lending standpoint, whether you're with a direct lender, a bank, or a credit union, they need to have six payments. So technically that's 7 months. They need 6 payments because if the loan is sold to an investor, which is what most banks, direct lenders, and credit unions do, if that loan is sold and then paid off early, that investor will come after the lender for their losses. So we need to have 6 months. Yeah, we're being honest about that now. Because, well, I mean, it's costing lenders millions. Yeah, millions of dollars. I have a gentleman who I just closed And he ended up selling a property and he wants to put $250,000 towards his balance. He's a retired guy. He's like, I want to pay this house off. So he wants to put the net proceeds of the sale towards the balance of his current loan. And I just closed his loan 3 months ago. Like, we gotta wait another 3 months and then I'll be happy to do that. And I'm like, and I think the interest rates will be lower, so I think you'll be happier with the overall transaction. But yeah, so we're really, really sticking strict. Yeah. It's called an EPO report. Really pay it. We don't want to see any of our loans.
Okay, so this is just an example and how all this rolls out. I think you guys are gonna get a copy of this, so you can kind of look at it. So clearly, if we're lowering the interest rate, which is gonna lower the payment, there's gonna be some cost to that, right? Because if our market rate is at 6.5, but you're making payments on 4.5, the lender's taking a loss, okay? So whatever that loss is for the first year, we're gonna add it to whatever the loss is to the second year, and that's gonna be the upfront cost for the 2-1 buy down. In this scenario, it's a little over 20,000. Keep in mind, this is a $1 million home, so this cost is gonna vary greatly depending on what you're buying. What we're gonna try to do now is we're gonna talk to your agent, we're gonna say, let's talk about seller credit opportunities. And we're gonna try to negotiate that so the seller pays for it, okay? Or at least some of it, yeah. So the reason we wanna do that is because we're coming into a low rate environment. I am advising my clients not to pay 1 cent towards their rate buy-down. The opportunities are there. Noel touched on it. If the savings is greater than the cost, by all means, and we'll probably lay that out by a few years. But what happens if we offer you a 6% rate, you buy it down to 5, and within 8 months, interest rates are at 4.5? Whatever you pay, yeah, whatever you pay towards that rate, and that comes out of your pocket in interest. It is a tax write-off. There's some benefit there, but it's still money you could have used for new flooring, for a new washer and dryer, right? So I am doing everything I can to protect your money and make sure that it's going towards things that aren't going to be a waste. Sometimes it's a means to get into a property. Some clients, their debt ratio is too high, they can't qualify, we buy their rate down, they qualify, they really want the house. That makes it worth it. Okay, because they're gonna end up accruing equity, which is gonna ultimately pay them back. But if we can help it, we want the seller taking on this cost, okay? It's a tax write-off to the seller. Tax write-off to the seller, okay? That amount of money is gonna make a much bigger impact in your payment versus the seller saying, oh, I'll just come down 20,000 in price. Take the credit, make a much bigger impact in your payment, okay? Okay. Well, on a home this size at $1 million, a price reduction to really, okay, so this is for a home that's been on the market. So they're not getting the buyer interest that they want. They're desperate. So in order to get some buyer interest, they're faced with lowering the purchase price. To make this something that people are gonna look at, they're gonna need to lower that 35, 40 grand. Or come up with 20 for the buyer.
Usually lower the buy down.
Yeah.
To a price reduction.
Yeah, much lower. So go ahead and go to the next one. I wanna try to wrap this up. This is what we call a permanent buy down. So let's say the seller's like, you know what? I'll give you an $8,000 credit. That's all I'm gonna give you. What I'm gonna do is I'm gonna take that $8,000 and I'm gonna see how far I can buy your rate down. And that's what we're gonna use that money for. Same thing, it just might not be as big of an impact in the payment, but it will be a bigger impact in the payment than not doing it at all, one, or that price reduction. So go ahead and. Okay, so this is just a historical forecast. Noel touched on building wealth with property, generational wealth, and buying a property is the biggest investment in your period. I always tell people, other than getting married and having a child, it's the biggest thing you'll ever do, but from a financial standpoint. And it's a very romantic notion to think about buying a house and building a family and all of that. But what you're not seeing is the wealth that you're building. Okay, right now, we're seeing roughly a little over 5% appreciation in property. Property's gonna, in normal markets, it's gonna appreciate anywhere from 5 to 6, sometimes 6.5. If it starts going over, we're getting into a market that is just that. We saw appreciation values of 18%, right? You turn on the news, they're saying, oh, it's crashing, it's not crashing, it's normalizing, it's still above normal. Okay, at 5.5. So this just illustrates what your property is gonna do over an 8-year period and how much money you're gonna make in putting in that property. Go ahead. And interest rates. Okay, I didn't want to get too into this. All I wanted to show you is how temporary rates are. Okay, each one of these, each movement in the market causes a movement in rates, inflation, recession, thank you. Okay, these are the things that are gonna drive interest rates. The Fed raising the Fed rate is gonna track interest rates, but that's not what causes interest rates to rise. But the one thing they have in common is inflation. Okay, so that's where you're gonna see all this movement in rates. So if you're buying in a market with higher rate, but a more balanced market with higher rates, you're gonna get a better price for the house. Yes, your rate's gonna be a little higher, but that rate's temporary. As soon as they come down, and they do, we're gonna refinance you out of it. I kind of already went through that. Oh, no, I'm sorry, go back. This is the rent versus own, okay. So I wanted to just kind of illustrate, renting versus owning. Okay, we all know the benefits of renting versus owning. You went through them. And so I just kind of wanted to show you some examples of how you get that money back. Because yes, we know that if you go get pre-approved, that mortgage payment's gonna be higher. We know that, okay? However, in a home that's priced in the $650 to $700 range, the average rent is, would you say 32 to maybe $4,000 in certain areas, okay? So I wanted to put together 3 different scenarios, 10% down, 5% down in FHA, okay? And show you these monthly payments at market rate, no buy downs, at market rate, okay? So on the 10% down, you're looking at $43.92. At the 5% down, you're looking at $46.46. And on the FHA, you're looking at $48.68. Various reasons are going to cause these payments to be different. The lender will go over that with you, okay? But the one thing, and people are like, oh, I paid $2,500. How am I going to how am I going to be able to afford that payment? And I'm going to show you. Okay. So, when Noelle was speaking, she was talking about interest rate tax deduction. So when you own a house, you're able to write certain things off in that house. And correct me if I'm wrong, Justin, but I want to say, well, right now everybody's working. So you can write off a portion of your house from working from home. I think it's 30% of the work area. You're not a tax. Okay, and I don't want to make any, anyway, you're writing off quite a few things by owning them, okay? But the biggest thing you're writing off is interest, it's the mortgage interest that you're paying, okay? So if you take this scenario, okay, you got a $617,500 loan, you're paying 6.125 on it. Your interest tax savings on this is $13,870 annually, a year, okay? Divide that by 12, and that's $1,055.83 of potential more income you're bringing into your house. It's gonna make up a lot of the difference in that payment and what you're paying. So when you're talking about rent payments versus mortgage payments, this is what's really gonna make the difference up. Now granted, it's the end of the year when you get this, it's called a tax refund, right? At the end of the year, okay? But this is what brings in more income, potentially this much income, and if you have more write-offs, that's gonna grow, that's just interest. Okay, And that is actually one of the biggest benefits of buying property in a higher interest rate market. Because when you refi and you lower the interest rate,
You don't have to bring it.
exactly, that's exactly right, yeah. So I just wanted to kind of show you, because just to bridge that gap, a lot of people, when interest rates are really low, this conversation never comes up. And it's a very important conversation. It's about the only conversation that I'm having with people now is let's figure out what you're gonna be able to deduct and what you're gonna bring in as the income at the end of the year to help you bridge the gap between your rent payment. So,
You can run up your property taxes, you don't need to $10,000.
yeah, yeah. Property taxes, yeah, there's even utilities. I mean, you would, a lot of people work from home, you can write off a percentage of your utilities, a percentage of your phone bill, percentage of. If you make repairs. Yeah. Yeah, please. Yeah, politics. It's another thing I'll talk.
I have a good,
Yeah. So does anybody have any questions? It's a lot of information, Yeah, it's great information. And again, I'm gonna go back to the same thing that I started with. Working with the right team is gonna make or break this experience for you. Okay, it's gonna protect you. It might even get you into a property that has multiple offers just because of the team that you're working with. It's really, really important. So if anybody has any questions, you're more than welcome to email me, call me. And that's it for me.
Thanks, guys. I know we went long, but we appreciate you coming. Nikki, you want to wrap us up and we'll send you a link to the recording of this.
Yes, you'll get a link, as well as the contact information for all of our panelists today. Thank Manny, thank you for coming. Thank you, Justin, and thank you, Janelle and Adam. Special shout out to the next SoCal team. It's our first event today. Our next event coming up, we'll be having an investors workshop coming up, that you won't want to miss, as well as our e-waste.
Yeah, we're having a shred event and an e-waste event on February 25th in Long Beach. If you want to have free shredding and e-waste disposal,
Get rid of those old iPhones, those iPhones.
we'll send you that information today, but we're also gonna have an investors workshop and that's March 14th. March 14th, we're gonna be doing that, again, via Zoom and or in person in the Long Beach area, to help you understand how to become a fledgling or seasoned investor. And those are the basics on that, talking about short-term rentals, ADUs, what that means, and talking about income, figuring out how you evaluate your return on investment for your purchases, all that kind of stuff. And we'll announce that in an email to everybody that registered today. So thank you.
Thank you all for attending, whether you signed on via Zoom, or you were here with us in person. We appreciate it. Look forward to seeing you again. Thank you.
Thanks, guys.
Yeah. That's it.
No.
It's live, right?